Want to build real wealth without constantly checking stock charts? These 3 dividend ETFs do exactly that. They pay you whether the market's up, down, or flat. In fact, one of them has raised its dividend every year for the past decade while doubling in price. The best part? You don't need to chase risky stocks or time the market. In this video, I'll show you 3 of the most powerful dividend ETFs that generate passive income and long-term growth backed by real numbers, not hype. If you want your money to work for you even while you sleep, this breakdown is your starting point. So, what are the top 3 dividend ETFs that actually grow your wealth passively? First, we'll break down how each fund works and why they're better than buying individual dividend stocks. Then we'll dive into their performance, risk, and future potential so you can decide which one fits your goals. These ETFs aren't random picks. They've been selected based on strict criteria: consistent dividend payouts, solid long-term returns, and diversified exposure. Whether you're building for retirement or just want income while you sleep, these funds do the heavy lifting for you. And here's the key: dividends aren't just about cash flow. When reinvested, they can massively accelerate wealth over time. This isn't theory. You'll see the numbers for yourself in this video. Let's get into the first ETF and why it's become a favorite for long-term investors chasing growth and income. There's a reason SCHD has become the go-to dividend ETF for long-term investors. It's not just about the yield, it's about how it's built. SCHD stands for Schwab US Dividend Equity ETF. It was launched in 2011 and tracks the Dow Jones US Dividend 100 Index. But what makes it different from other dividend ETFs is the quality screening it applies before adding any stock. Here's how it works. SCHD looks for companies that have paid consistent dividends for at least 10 years. But it doesn't stop there. It scores each company on 4 key factors: dividend yield, cash flow to debt, return on equity, 5-year dividend growth rate. Only the top 100 scoring companies make it into the ETF. That means you're not just getting high-yield stocks, you're getting high-quality companies with strong fundamentals. SCHD holds names like PepsiCo, Home Depot, Cisco, and Amgen. It leans toward value-oriented sectors like consumer staples, industrials, and financials, less exposure to volatile tech. As of 2025, SCHD offers a dividend yield around 3.6%, paid quarterly. But what's more impressive is its dividend growth. Over the past 5 years, its average annual dividend increase has been over 11%, meaning your income grows along with your portfolio. It also has one of the lowest fees in the ETF space, just 0.06% expense ratio. SCHD isn't flashy, but it's efficient, disciplined, and built for serious long-term investors. It combines steady income with rising payouts, making it one of the strongest core holdings for passive income seekers. SCHD isn't just built well on paper, it's delivered in real portfolios too. But can it keep winning over the next decade? Let's look at the numbers. Since its launch in 2011, SCHD has delivered an average compound annual growth rate of 12.6% through early 2024, including both price growth and dividends. To put that in perspective, an investment of $10,000 in SCHD in 2013 would now be worth over $33,000, assuming dividends were reinvested. Back in 2013, SCHD paid roughly 88 cents per share annually. By 2024, the annual dividend rose to about $2.73 per share. That means an investor who bought and held would now be earning over 3 times more income per share than they were at the start without adding any new capital. SCHD has also shown resilience in downturns. In 2022, while the S&P 500 dropped approximately 18%, SCHD declined by just 3.2%, highlighting the defensive nature of its holdings. Looking forward, SCHD's heavy exposure to financials, industrials, and healthcare gives it an advantage in a high-interest or inflationary environment. These sectors tend to outperform when rates are elevated or consumer demand shifts toward essentials. However, SCHD may lag during tech-driven bull markets. With limited exposure to companies like Apple or Nvidia, it's less likely to capture explosive upside during growth surges. Also, about 40% of the fund is concentrated in its top 10 holdings, which introduces some risk if any of those companies underperform. SCHD combines dividend reliability with long-term growth. It's not built to chase the hottest sectors, but it's built to endure, compound, and pay steadily over time. If SCHD is about dividend quality, VYM is about dividend breadth, and that has serious long-term advantages. VYM stands for Vanguard High Dividend Yield ETF, and it takes a different approach than SCHD. While SCHD focuses on a select group of high-quality companies, VYM aims for broad exposure to high-yielding U.S. stocks. It tracks the FTSE High Dividend Yield Index, which includes over 400 companies. This ETF doesn't filter for dividend growth or apply strict quality screens. Instead, it targets companies with above-average yields across various sectors, giving it a wide net and a strong emphasis on diversification. As of early 2025, VYM offers a dividend yield of around 3.1% paid quarterly. Its holdings include names like Johnson & Johnson, JP Chase, Procter & Gamble, and ExxonMobil. These are large-cap, established companies with mature business models and steady cash flows. Where VYM really stands out is in its sector balance. Compared to SCHD, it has less concentration risk. Its top 10 holdings make up only about 20% of the portfolio versus SCHD's 40%. It also has broader exposure to energy and utilities, which can help during inflationary or volatile market conditions. And of course, because this is Vanguard, you get low costs. VYM's expense ratio is just 0.06%, making it one of the most affordable dividend ETFs available. VYM is built for passive income seekers who want high yield and broad diversification. It may not be as focused as SCHD, but it offers lower concentration risk, wider sector exposure, and stable payouts, making it a solid core holding for long-term income. VYM isn't designed to chase the market, but it's built to endure it. So how has it actually performed? Since its inception in 2006, VYM has delivered a long-term CAGR of around 8.5%, factoring in both price appreciation and dividends. It's not the highest returning ETF on the market, but it's been consistent, and that consistency is what passive income investors are often looking for. If you had invested $10,000 in VYM in 2013, it would be worth over $23,000 today, assuming dividends were reinvested. Over the same period, VYM maintained a dividend yield typically ranging between 2.8% and 3.3%, offering investors a stable stream of income through both bull and bear markets. VYM tends to perform well in stable or inflationary environments, where consumer staples, healthcare, and energy stocks maintain pricing power. During periods of volatility, its broad diversification helps reduce portfolio swings compared to more concentrated ETFs. In 2022, while growth-heavy ETFs suffered large drawdowns, VYM held up relatively well, declining around 5.4% compared to over 30% drops in tech-heavy funds. This reflects its lower beta and focus on companies with strong cash flows and dividends. Looking forward, the same characteristics that helped VYM weather past storms, sector diversification, lower valuation risk, and consistent yield position it well for a market cycle where stability and cash flow are rewarded. VYM won't deliver explosive growth, but that's not what it's built for. Its historical performance shows steady gains and dependable income, making it a reliable choice for investors who value durability over flash. Looking for income right now? JEPI offers high yield, but it works differently than most dividend ETFs. JEPI, or JP Equity Premium Income ETF, isn't your typical dividend fund. Rather than focusing solely on dividend-paying stocks, it uses a covered call strategy to enhance its yield. What that means is, JEPI writes call options on the stocks it owns, allowing it to collect premiums from those options. This strategy generates income, which is then paid out to investors as dividends. As of early 2025, JEPI is offering an attractive 7.9% annual yield, far higher than typical dividend ETFs like SCHD or VYM. JEPI's holdings include well-established companies such as Apple, Microsoft, and Johnson & Johnson stocks with relatively stable growth, making them good candidates for covered calls. The options premiums help boost income, but also cap the upside potential of the fund. If one of its stocks gets called away, for example, bought at a predetermined price, the fund doesn't benefit from any further price gains beyond that strike price. The key benefit? High immediate income. JEPI's strategy provides an income stream that's significantly higher than more traditional dividend ETFs, perfect for investors who need cash flow now. JEPI is an ideal choice for income-focused investors who want higher yield without taking on excessive risk. It's not about capital appreciation here. It's about getting paid while still holding strong, stable companies. JEPI's high yield is impressive, but how sustainable is it over the long term? Since its launch in 2020, JEPI has delivered impressive yields, ranging from 7% to 9% annually. In 2022, its yield was around 8.5%, and even in 2023, it maintained a 7.8% yield, significantly higher than most dividend ETFs. But there's a catch. While JEPI's yield looks attractive, it's the covered call strategy that drives this high payout. Covered calls generate income by selling options, but this also means JEPI's upside potential is limited. In a market where stocks are soaring, JEPI may lag because it won't benefit from the stock price increases beyond the option strike prices. This could be a risk during bull markets. If the market experiences strong growth, JEPI's strategy could lead to underperformance compared to growth-oriented ETFs like SCHD. However, in sideways or volatile markets, JEPI's covered calls offer a more stable income stream, protecting against downside while still providing cash flow. Another risk to consider is low dividend growth. Since the income comes mainly from the options premiums, JEPI may not show the same dividend growth over time as traditional dividend ETFs. Investors looking for consistent, growing dividends might find this strategy less appealing in the long run. JEPI's high yield is great for income today, but its strategy may limit future growth. If you're after high income with some volatility protection and aren't concerned with huge capital appreciation, JEPI could be a strong choice, but it's important to recognize the trade-off. If you found this video helpful, don't forget to subscribe for more ETF breakdowns and strategies to grow your wealth. If you're looking for a more aggressive strategy, check out my video on stocks that could 10x in the next decade. And for a solid long-term plan, don't miss my video on building a 3 ETF portfolio strategy.